You've been told a story, a clean, simple story, that if you pay your bills on time, keep your balances low, avoid debt like a responsible adult, a number will rise, and that number will open doors. You think your credit score is your financial identity. You're wrong. That number is just a mask covering a much deeper, more clinical judgment of your worth. Banks don't just ask, "Can this person repay us?" They ask something far colder: how much can we make off this person? And if your answer is not enough, the door doesn't open, no matter what the mask says. So here is the question no banker will ever ask you out loud. Not, "Are you creditworthy?" but, "Are you profitable enough to be worth our time?" Behind the FICO score, you see, lies the score they'll never show you. It's pulled from your zip code, your education level, even the way you speak to customer service. They call it customer lifetime value. I call it the shadow score. And it's the reason why being responsible is exactly why the bank might quietly decide you aren't worth the investment. Meet Sarah. Sarah is not a cautionary tale. She is, by every standard measure, a financial success story. Credit score, 814. Savings rate, 31% of her monthly income. Outstanding debt, 0. She has never missed a payment, never carried a balance on a credit card, never borrowed more than she needed. Sarah did everything right. So when Sarah applied for a mortgage on a modest home, she wasn't nervous. She had earned this. She had the receipts. The letter arrived 11 days later. Not a rejection, something stranger. An approval at a standard rate, not the premier rate she'd seen advertised, not the rate her colleague Marcus, who carries 3 credit cards near their limits, had received the week before. A higher rate. On a lower-risk borrower. Sarah called the bank. She was polite. She was precise. She had her FICO score written on the notepad in front of her. Like armor. The representative told her the rate reflected her overall profile. She asked what that meant. Silence. The representative moved to the next prompt. What Sarah didn't know, what she couldn't know, was that she had been assigned a label, not in the premier pile. In a third pile, the bank doesn't advertise. The label said, low yield. In the internal language of banks, Sarah was something worse than a risk. She was what the industry quietly calls a deadbeat. Not because she defaulted, but because she never paid interest, she never triggered a late fee, she never rolled a balance, she paid in full, every single time. Sit with that for a moment. The most financially disciplined person in the room received the worst offer at the table. A bank doesn't make money from someone who closes the loop every month. They make money from the gap, the spread between what you owe and what it costs them to hold that debt. Sarah closed that gap completely. And there was something else the letter didn't say. Sarah had spent 17 years at the same bank. 17 years of direct deposits, 17 years of savings accounts, earning her 0.01% annual interest, while the bank lent her deposited money to other customers at 22%. She wasn't just unprofitable, she was a liability they had been quietly funding, while making nothing on the relationship. Unprofitable customers don't get the best rates. They get the rates that make them just profitable enough to bother with. Sarah closed her account 6 weeks later. The bank sent her an automated retention email. It offered her a toaster. Here is the asymmetry of information. You spend your life trying to satisfy FICO, the public score. It measures 5 things: payment history, utilization, length of credit, new inquiries, credit mix. It was designed to answer one question. Will this person repay? That's the mask. Behind it lives a separate infrastructure. Analysts call it customer lifetime value modeling. CLV, and paired with it, something called an internal risk rating. These are not regulated disclosures. You cannot request them under the Fair Credit Reporting Act. You will never see them on an annual credit report. They are, in the truest sense of the phrase, your shadow score. Unlike FICO, which looks backward, these scores are built to look forward. They want to know not what you've done, but what you will do. How much you'll borrow, how long you'll carry it, how often you'll pay the minimum instead of the full balance. They are building a model of your future financial surrender. What feeds these models? First, data brokers. A company called LexisNexis Risk Solutions maintains files on over 278 million Americans. They don't call them credit files. They call them risk profiles. These profiles pull from court records, property records, address history, and purchase data. Banks license this data legally. It flows into your shadow score before you filled out a single application. You did not consent to this, you were not asked, and there is no equivalent of a credit freeze that stops it. If the bank already has a file on you before you walk in the door, what exactly is the application for? Second, your zip code. Not just because of property values. Because of what your zip code's churn rate looks like, banks measure how many people in your neighborhood changed financial institutions in the last 18 months. That number has a name inside the industry. They call it a mobility risk index. If your neighbors leave, you are statistically more likely to leave, and a customer who leaves is a customer who stopped generating revenue. A high churn zip code is a flag. It tells the model, this person may not stay long enough to be extracted from. And extraction requires time. Third, your education level. Estimated, not declared. The model infers it from your address, your vocabulary on customer service calls, and the types of financial products you have historically held. Education level predicts two things: your earning trajectory and your financial sophistication. And here is where the algorithm becomes genuinely perverse. The more financially sophisticated you are, the harder you are to extract value from. The bank would prefer you to be capable enough to repay, but not quite sharp enough to optimize. They want you to almost understand compound interest. To kind of know what an APR means, to be smart enough to hold a credit card, but not quite savvy enough to pay it off every month without thinking about it. There is a real name inside quantitative finance for this target customer. They call them revolvers. Not because they spin, but because their balance revolves. It carries, it compounds, and it generates revenue every single month automatically. The algorithm identifies you as a revolver, or a non-revolver like Sarah, before you apply, and it prices accordingly. Fourth, the ability to pay pricing model. This is the dark side of success. Banks use your income data pulled from credit bureau estimates, property tax records, and employer data to determine not just your risk, but your price sensitivity. Someone earning $200,000 a year is often less likely to spend an afternoon comparison shopping for a better mortgage rate. They are busy. They are comfortable. They have optimized for time, not price. The algorithm knows this. It predicts that you won't notice a few extra percentage points, or that you'll notice and not act. Your high income becomes a signal that you can be charged more without losing your business. They call it yield optimization. I call it a tax on your success, and it runs silently, in the background, every time you click apply. This is the digital border, the kind that determines which financial neighborhood you're sorted into before you've said a single word. Every data point, every click, every zip code, every customer service ticket is another brick in the wall. But here's what the wall is actually made of. Systems don't have to be malicious to be harmful. They just have to be optimized. And when optimization is pointed at profit, people become inputs Financial institutions have effectively sorted the population into two categories: the extractable class and the elite class. The extractable class is the middle. People who earn enough to take on debt, but not enough to pay it down quickly. People who are one emergency away from a missed payment. People with just enough financial stability to qualify for products and just enough financial pressure to stay in them. These are the people who pay credit card interest month after month, who take on car loans they can technically afford, but only barely, who roll over balances. These are the people banks call highly profitable. These are the people the algorithms are designed to identify and keep. The elite class operates under entirely different rules. Their wealth is primarily in assets, not income. They borrow not out of necessity, but strategy, using debt as a lever, not a lifeline. They receive the lowest rates, the best products, because the bank is not trying to extract from them. They are trying to retain them. Their money is the raw material the bank uses to lend to everyone else. Now sit with the geometry of this for a moment. The bank takes deposits from the middle class, pays them a fraction of a percent in interest, and lends that same money back to other people in the middle class at 15, 20, 25%. This is not a conspiracy. It is a mechanism. A vacuum shaped like a building with a customer service number. Money flows in at the bottom, returns as debt at the top, and the spread between those two numbers is captured permanently. Economists call this the net interest margin. I call it the asset vacuum. Here is what it looks like in real numbers. The Federal Reserve reports that the average savings account in America earned 0.46% annual interest in 2023. In the same year, the average credit card APR was 22.8%. The average car loan was 7.1%. The average personal loan was 11.5%. The gap between 0.46% and 22.8% is not accidental. It is the engine. And the shadow score is the throttle. It determines who gets priced at 12% and who gets priced at 24%. It determines who receives a balance transfer offer in the mail and who receives a credit line increase they didn't request. It determines who gets called a valued customer and who gets automated retention emails offering a toaster. The shadow score is not a flaw in the machine. It is the machine. It is the optimization layer that ensures the asset vacuum extracts maximum yield from the extractable class while protecting the relationship with the elite class. And here is the part that doesn't get discussed enough. The middle class is not just being charged more. They are being used. Their deposits are the raw capital that funds the loans they pay 22% on. They are simultaneously the fuel and the combustion, the cow and the dairy. There is no corruption here in the legal sense. No smoking gun, no secret meeting. There is just a model running in a data center assigning scores to people who will never see them, filing human beings into categories they can't appeal, and pricing them accordingly. I'm not going to give you a list of tips. I'm not going to tell you which credit card to open or which bank to switch to, because the problem isn't your tactics. The problem is the frame. You have been taught to play a game without ever being shown the full board. The score you are given is real, but it is incomplete. It measures your creditworthiness, not your value. It tells the system whether you can be trusted to repay. It does not tell you whether the system can be trusted to treat you fairly. What we know is this: somewhere in a data center you'll never visit, a model is running. It has pulled your zip code, your payment behavior, your estimated education level, your mobility risk index, your churn probability, your yield potential. It has rendered a verdict, and it has filed you without your knowledge, without your consent, and without any mechanism for appeal. LexisNexis has a file on you. Your bank has a customer lifetime value score on you. Your zip code's churn rate is being counted against you. The way you talk on a customer service call has been transcribed, analyzed, and fed into a model that is deciding right now whether you are worth the investment. The question isn't how to get a better score in a system designed to score you. The question is, who gave them permission to score you at all? And what does it mean when the answer is no one? In a system that scores you on how much you can lose, the only winning move is to own the game itself. Not to optimize within the rules, but to understand the rules so completely that you stop being the kind of customer they're building these models to keep. The system isn't broken. That's the thing they never say out loud. It is working exactly as designed, for exactly the people it was designed to serve. You are not a customer to this machine. You are a data point with a direct deposit. My name is Clara, and this is the Shadow Score.